Hello students, welcome to another video lecture of Upskilling Commerce series. Today we will be discussing about Employee Provident Fund. Even though most college students haven't started earning yet, but it's important to understand PF because it is something you will start contributing to from your first job itself, and it teaches you the habit of saving regularly without thinking about it. PF helps you understand salary structure because it is a part of your salary deductions, and you will know what to ask HR about during your job offer, like UAN, PF contributions, withdrawal rules, etc. PF is a retirement benefit, but many people end up using it during financial emergencies. You don't have to be earning to learn this topic, but knowing now helps you take smarter steps later. So let's start. So what is Provident Fund? Provident Fund is a long-term savings scheme designed to help employees build a financial cushion for their future, especially after retirement. Under this system, a fixed percentage of an employee's salary is deducted every month and contributed to their PF account with an equal contribution made by the employer. The money in the PF account earns interest and is managed by the employee's Provident Fund organization or the government. Over time, these regular contributions grow into a substantial amount which can be withdrawn at retirement or used for specific needs like medical expenses, education, marriage, or buying a home. It's essentially a compulsory savings tool to ensure financial security and disciplined savings. Now let's talk about different types of Provident Fund in India. The first is EPF. The Employee Provident Fund is meant for salaried employees in the organized sector, where both the employee and employer contribute a fixed percentage of the basic salary each month, and the funds earn interest while being managed by the EPFO. Next is PPF. The Public Provident Fund is open to everyone, salaried, self-employed or unemployed, and is a government-backed scheme with a 15-year lock-in offering safe, long-term savings and tax-free returns. And the last is VPF. The Voluntary Provident Fund is an optional extension of the EPF where employees can contribute more than the mandatory limit to boost their savings, earning the same interest rate as EPF and enjoying similar tax benefits. Together, these PF options encourage disciplined savings and ensure financial security for different types of individuals. Now let's talk about PF contribution breakdown. In the Employee Provident Fund, contributions are made by both the employee and the employer at a fixed rate of 12% of the employee's basic salary plus dearness allowance each month. The employee's entire 12% share goes directly into their EPF account, while the employer's 12% is split into two parts. 8.33% goes to the employee pension scheme and the remaining 3.67% goes into the employee's EPF account. For example, if an employee's basic salary is 25,000, the employee contributes rupees 3,000 to EPF, while the employer contributes 3,000, out of which 2,083 rupees goes to EPS and 917 rupees goes to EPF. This combined monthly contribution steadily grows with interest, creating a significant retirement fund over time. Current rate of interest is 8.25% per annum. This interest is calculated based on your monthly running balance. Then the cumulative interest is added to your EPF account at the end of the financial year, usually on March 31st. Now let's discuss benefits of Provident Fund. The first is safe and government-backed. PF is managed by the Government of India. One of the biggest advantages of the Provident Fund is that it's a completely safe and secure investment. It is managed by the Employees Provident Fund Organization, a government body under the Ministry of Labour and Employment. This makes PF a low-risk saving tool, ideal for individuals who want to build a stable financial base without worrying about market volatility. Unlike stocks or mutual funds, where your returns are not guaranteed, PF offers safety and reliability, making it an excellent option for long-term financial planning. The next is tax-free interest. Interest earned and maturity amount are tax-free under Section 80C of the Income Tax Act. The money in your PF account doesn't just sit there. It earns interest every year, typically in the range of 8 to 8.50%, which is higher than most bank fixed deposits. What makes it even more attractive is that the interest earned is completely tax-free under Section 10 of the Income Tax Act, provided you withdraw it after at least 5 years of continuous service. Moreover, the amount you contribute to your PF account is also eligible for tax deduction under Section 80C up to 1,50,000 per year. This means PF not only helps you save for the future but also reduces your tax burden in the present. The next is retirement corpus. You will have a lump sum amount ready when you retire or when you change jobs. One of the primary purposes of the PF system is to help you build a corpus for your retirement. Throughout your working years, you and your employer both contribute a fixed amount every month to your PF account. Over time, with regular contributions and compounded interest, this amount grows significantly. When you retire, you can withdraw the full PF amount as a lump sum, giving you a financial cushion to support your life after employment. For many people, PF ends up being their largest saving fund by the time they stop working. The next is partial withdrawals allowed. For marriage, home purchase, medical emergencies, partial withdrawals are allowed. While PF is primarily a retirement benefit, the EPFO allows you to make partial withdrawals from your PF account for specific life needs. These include higher education, marriage, medical emergencies, buying a house, or repaying a home loan. Each of these withdrawals has its own rules. For example, a minimum number of years of service may be required for some cases. However, for medical reasons, you can withdraw at any time. This makes PF a flexible and helpful financial tool, allowing you to access your savings during important phases of your life and not just at the end. The next is disciplined saving. You don't have to think. It's automatically deducted and invested monthly. Your employer is basically saving for you, along with you. Perhaps one of the most underrated benefits of PF is that it builds a strong saving habit without you having to think about it. Since the PF contribution is deducted automatically from your salary every month, you have consistently without any extra effort. Over time, this creates the habit of paying yourself first, which is the foundation of good financial planning. The best part is you don't miss the money because it's never in your hands to spend. As a result, PF teaches the principle of long-term financial discipline, which becomes incredibly valuable as your income grows and your financial responsibilities increase. The Employee Provident Fund is a compulsory retirement savings scheme under the EPF and Miscellaneous Provisions Act 1952. Any organization with 20 or more employees must register with the EPFO and provide EPF benefits to eligible staff. However, small companies with fewer than 20 employees can also voluntarily register if they want to offer this benefit. If an employee's basic salary plus DNS allowance is 15,000 rupees or less per month at the time of joining, they must be enrolled in EPF with no choice given. Employees earning more than 15,000 can opt in only if both the employee and the employer agree. This is called a voluntary coverage under EPF. Once enrolled, contributions continue every month regardless of future salary increases unless the employee withdraws PF after leaving the organization. Now let's learn about UAN. UAN is the Universal Account Number, which is a 12-digit number for your PF account that is unique to you, like a PAN card. You will get one UAN for life no matter how many jobs you change. Every new employer links their PF account to your UAN. You can check your balance online, download your passbook, request withdrawal or transfer, and also update KYC details. You can even check your PF using the EPFO portal, Umang app, or through SMS services. UAN gives you full online access of your PF account. By logging into the EPFO member portal, you can check your PF balance, download your passbook, view monthly contributions made by your employer, update personal details, and even apply for withdrawals. It also provides SMS and email alerts whenever your employer deposits money to your PF account. UAN allows you to complete your KYC process by linking your Aadhaar card, PAN card and bank accounts. As your UAN number remains the same throughout your working life, no matter how many times you switch jobs. Earlier, changing jobs meant creating a new PF account each time, which made tracking your savings difficult. With UAN, all your PF accounts are linked under a single identity, allowing you to manage your entire career's PF savings in one place. With UAN, you can easily transfer your PF online through the EPF portal, and the process is much faster and more efficient. In conclusion, Provident Fund is not just a statutory requirement but a powerful tool for long-term financial security. By understanding its structure, contribution rules, withdrawal provisions, and tax benefits, employees and employers can both maximize its advantages. PF instills the habit of disciplined savings, offers a safety net during retirement or emergencies, and ensures compliance with labor laws. In today's dynamic financial landscape, staying informed about PF provisions empowers individuals to plan a stable and secure future while fostering a culture of financial responsibility in the workplace. So that's all for Employees Provident Fund. Now we will meet in another video of Upskilling Commerce with a new topic. Till the time, thank you.